Danielle Picotte, Corey Wren, University of Berkshire Hathaway. 30 years of lessons from Buffett and Munger's annual meetings. For decades, an unconventional university was in session. It had no formal campus, and its curriculum unfolded year by year. Its professors were two of the most successful business minds in history, and the classroom was their annual shareholder meeting. Students who dedicated themselves to this course of study absorbed the professor's entire way of thinking, their discipline, their character, and their core principles. This approach transformed how they saw the world. It allowed them to filter out the noise and focus on what truly matters, marking a journey from passive spectator to an active participant in their own success. This blink distills 3 decades of lessons from the legendary annual shareholder meetings between Warren Buffett and Charlie Munger of Berkshire Hathaway. You'll learn the complete mental operating system of these masters, discover the foundational ideas that guided every decision they made, and see how their philosophy evolved over 30 years of real-world tests. By the end, you'll be equipped with the tools to assess value, the discipline to act rationally under pressure, and the patience to build enduring success. The foundation of the university. Your first lesson with Warren Buffett and Charlie Munger begins with a core principle that governs every decision they make. It's an idea inherited from their teacher, Benjamin Graham. There's an absolute distinction between the price of something and its actual value. In other words, it's important to understand that price and value are two different things. Price is what you pay for a stock on any given day, while value is what the underlying business is truly worth. The entire art of investing, as they teach it, is to figure out the value of a business, and then wait for an opportunity to buy it at a significant discount. This discount is what Graham called the margin of safety. The purpose of this discount? To create a buffer that absorbs errors in judgment and the inevitable dose of bad luck. Buffett compares this to building a bridge that can support far more weight than the trucks you plan to drive over it. That's your margin of safety, and it's what protects you from catastrophic loss. Once you understand what you're looking for, you then need to learn how to behave. This is where you meet Mr. Market, an allegorical business partner invented by Graham to illustrate the irrationality of the stock market. Some days, Mr. Market is euphoric and offers to buy your shares at ridiculously high prices. On other days, he's panicked and offers to sell you his shares at absurdly low prices. The lesson is to view the market as your servant, offering opportunities rather than dictating actions. You should feel free to ignore him on most days and be ready to take advantage of him when his emotional swings offer you a bargain. This is why Buffett and Munger stressed that temperament is the most important quality for an investor. You need the emotional stability and discipline to act greedily when others are panicked, and to be fearful when others are euphoric. That said, this timeless philosophy has evolved. While Graham's approach remained heavily quantitative, focusing on assets you could easily count, Buffett and Munger began to incorporate a broader view of a company's worth. They championed the idea of intrinsic business value, a concept that gives weight to powerful intangible assets. These are things like the talent of a company's management team or the durable competitive advantage provided by a world-class brand. This subtle shift in thinking, valuing the quality of the business itself, was the key that unlocked the next stage of Berkshire Hathaway's spectacular growth. Building the empire. The investing approach that defined the first part of Warren Buffett's career was a purely quantitative one, a strategy he colorfully named the cigar butt approach. The idea was to scour the market for discarded, ugly businesses that were trading for less than the cash on their books. Like finding a soggy cigar butt on the street, it might be unpleasant, but it had one last free puff of profit left in it. After that single puff was enjoyed, you could toss it aside and look for another. The original Berkshire Hathaway textile mill, a dying business in a declining industry, was precisely this kind of investment. This method was profitable, and yet it was also laborious and limited. You could never build a truly great enterprise out of a series of discarded cigar butts. The change came through the influence of Buffett's partner, Charlie Munger. It was Munger who steered Buffett toward a more enduring philosophy that championed what he later termed owning a wonderful company for a fair price. This was a revelation. It shifted the focus away from a company's liquidation value and toward the quality of the business itself, its long-term earnings power, and its sustainable competitive advantages. The goal became finding an exceptional enterprise that you could own for a very long time, allowing its value to compound. This new philosophy was put to the test in 1972 with the acquisition of See's Candies. See's was the opposite of a cigar butt. It was a great business with a powerful brand that commanded fierce customer loyalty, especially in California. This single purchase became a crucial part of Buffett and Munger's education, teaching them firsthand about the value of intangible assets. A strong brand, they learned, creates a protective moat around a business's economic castle, warding off competitors. Even more importantly, See's demonstrated the magic of a business that requires very little capital to grow. Year after year, it generated enormous profits while requiring only a tiny fraction of those earnings to be reinvested back into the company. The rest of the cash flowed to Berkshire's headquarters in Omaha, ready to be deployed into the next opportunity. This experience was so transformative that Buffett later acknowledged the lessons from See's were absolutely essential to his eventual decision to buy Coca-Cola. The small investment in a box of chocolates gave him the insight he needed to recognize the same brand dynamics in a can of soda, leading to a multi-billion-dollar investment. Crisis warnings and corporate governance. The strategy of buying wonderful businesses created a new dynamic for Berkshire Hathaway. These companies began generating enormous and consistent floods of cash that flowed back to Omaha. This welcome development posed a new challenge. How could they intelligently reinvest this ever-growing mountain of capital to acquire even more wonderful businesses? The answer lies in the financial engine at the very heart of Berkshire, a concept you need to understand in order to understand their success. It's called insurance float. To grasp what float is, think about how an insurance company operates. It collects premiums from customers today for accidents and losses that may happen months or even years in the future. That massive pool of money an insurer holds, which will eventually be paid out to claimants but can be invested for the company's own benefit in the meantime, is float. The story of this engine began in 1967 when Berkshire acquired National Indemnity, a small Omaha insurance company, for $8.4 million. This single acquisition became the foundation for an insurance empire and the primary source of the float that would fuel its growth for the next 50 years. You can think of float kind of like a bank taking deposits, except with a twist. Banks have to pay interest to use their depositors' money. Insurers, on the other hand, can do something pretty remarkable. Get paid to hold and invest other people's money. The catch? It only works if they stay disciplined, only writing policies where the risk is priced right. Still, a lot of insurers fall into the trap of chasing growth, taking on bad business just to hit higher premium numbers each year. Berkshire does the opposite. When prices don't make sense, they're totally fine with letting the business shrink, because what matters most is keeping the cost of float as low as possible. Thanks to that discipline, Berkshire has often ended up with a cost of float that's less than zero. In those years, customers were essentially paying them to hold and invest their money. This engine, maintained by discipline and supercharged by geniuses like Ajit Jain, who orchestrated massive float-generating deals, grew from a modest $17 million in 1967 to an incredible $70 billion by 2012. Munger summed it up best: using low-cost float to buy high-return businesses is a winning formula. That's exactly what Berkshire did when they used the steady stream of insurance float to invest in companies like Coca-Cola and American Express, and to acquire others outright. The beauty of float is in the paradox. On a standard balance sheet, it shows up as a liability, money that technically belongs to someone else. But for Berkshire, it's worked more like a revolving, low-cost pool of capital, often more useful than traditional equity. Thanks to the steady engine of their insurance operations, Buffett and Munger had a rock-solid financial foundation. That gave them something rare: the freedom to tune out Wall Street's noise and stick to their principles. A discipline that would soon be put to the test as the rest of the financial world started to lose its grip. staying sane when markets go mad. A rock-solid financial foundation built on the steady profits of the insurance business model gave Buffett and Munger something most investors lacked: the peace of mind to stay disciplined. That kind of security was priceless when the market started losing its grip on reality. During the dot-com frenzy of the late 90s, while others were throwing money at anything with a .com in the name, Buffett and Munger famously sat it out. They held on to cash, ignored the hype, and took plenty of heat for being out of touch. But they knew better than to trade long-term sense for short-term buzz. Their inaction was a deliberate choice, rooted in the principle of staying within their circle of competence. They avoided technology stocks simply because they felt they could not confidently predict the long-term competitive position or earnings power of those businesses. Munger wryly noted that when you mix a good concept like the internet with irrational excess, the result is still just irrational excess. Knowing when to stay away from things you don't understand, especially the popular flashy stuff, is one of the best ways to avoid costly mistakes. The pressure to jump in can be overwhelming, fueled by one of the trickiest emotions in investing: envy. It's hard not to feel tempted when you see others making big gains on risky bets, but giving in often means abandoning your own good judgment. That's why Buffett and Munger always emphasized that temperament matters more than raw intelligence. They saw plenty of smart people get themselves into trouble by using their brains to justify risky or foolish moves. The real skill is having the emotional discipline to stick with a simple, solid strategy. That's what separates great investors from the rest. Widespread folly creates the perfect environment for both corporate fraud and systemic risk. Long before the 2008 crisis, Buffett was already sounding the alarm about derivatives, calling them financial weapons with the power to cause massive damage. These complex products hid enormous leverage and risks that even their creators didn't fully grasp. On top of that, a corporate culture obsessed with showing smooth, predictable earnings led to accounting tricks and misleading metrics like EBITDA, a term Munger famously called bullshit earnings. The key takeaway? Learn to spot the warning signs of bad character and financial smoke and mirrors, and steer clear. For Buffett and Munger, this long stretch of watching others fall into these traps was also a time to stay disciplined and patient. They kept their minds sharp and their cash ready, positioning themselves perfectly to act when these problems pushed the global financial system to the edge. The modern Berkshire. In the fall of 2008, the entire global financial system was pushed to the brink. Well, almost the entire system. In a period of total panic, when credit markets were seizing and major financial institutions were collapsing, Berkshire Hathaway stepped in as the buyer of last resort. With Wall Street gripped by fear, Buffett became the person to call. He acted with speed and creativity, orchestrating a series of legendary deals that stabilized key institutions while securing extraordinary terms for Berkshire. For instance, in a matter of days, he negotiated a $5 billion investment in Goldman Sachs. The deal provided Goldman with a critical capital injection and, more importantly, the Berkshire seal of approval. In return, Berkshire got preferred stock with a 10% dividend, plus valuable warrants to buy Goldman common stock at a bargain for years ahead. They made similar deals with General Electric and others. This was the payoff for decades of discipline, having the capital and the guts to be greedy when everyone else was scared stiff. Those crisis-era investments, along with huge acquisitions like the BNSF Railroad, shaped what Berkshire Hathaway is today, a self-sustaining powerhouse for allocating capital. It's no longer just a collection of stocks, but a vast network of strong operating businesses. The Powerhouse Five, BNSF, Berkshire Hathaway Energy, Marmon, Lubrizol, and Iscar generate billions in earnings that they can reinvest each year, tackling the challenge of putting Berkshire's growing cash flow to work. Combined with a top-notch team of investment managers, this creates a company built to compound wealth for generations to come. The final and most important component of this enduring machine is its culture. Buffett and Munger have cultivated a unique environment of decentralization, rationality, and extreme trust. This culture has made Berkshire the preferred permanent home for successful family-owned businesses, and their reputational advantage is a competitive moat that's nearly impossible for others to replicate. The succession plan is all about preserving this culture that made Berkshire what it is, making sure the lessons learned over a lifetime keep guiding the company long after its founders are gone. While optimism has always been a core tenet of the Buffett-Munger philosophy, the final lesson from their university is a practical one. In a world full of uncertainty, it pays to keep your expectations modest. As Munger put it, the secret to happiness is having low expectations. In this Blink to University of Berkshire Hathaway by Daniel Pecor and Corey Wren, you've learned that exceptional investing isn't about chasing trends. It requires a disciplined mindset built on buying quality businesses with a margin of safety, fueled by a unique financial engine and protected by the psychological fortitude to be greedy when others are scared. It all started with Benjamin Graham's core idea: treat the market as your servant, not your guide, and always demand a discount to a business's true value. Charlie Munger added his twist: focus on owning a handful of wonderful, durable companies that generate steady cash. Warren Buffett and Munger supercharged this philosophy with insurance float, a powerful source of low-cost capital they put to work for decades. Ultimately, this combination of a sound philosophy and a secure financial fortress allowed Berkshire Hathaway to thrive during crises and build a decentralized culture designed to endure long into the future. Okay, that's it for this Blink. We hope you enjoyed it. If you can, please take the time to leave us a rating. We always appreciate your feedback. See you soon.